Ford CEO just dropped a bombshell. I'll show you why it's a crisis in the making. As the supply of critical components has been trickling out of China, which has instituted a new approval process for the exports of rare earths that continues to slow supply lines. And now we can start to see why President Trump was so eager to get an initial deal with China done last week, because we are in desperate need of rare earths, because the problem is it's about to shut down production in a major way. It's day to day, Jim Farley, the CEO of Ford, said. We've had to shut down factories. It's hand to mouth right now. And so you can see the motivation behind China's side here. They have no incentive to increase the export of rare earths because they know it's a source of pain for the U.S. economy. Because when you shut factories down, you put people on the unemployment line. And when that happens, next thing you know, you can drive your opponent's economy right into a recession. So you can see now why we need them so bad, because it's about to shut down our entire automotive industry. Ford idled its Explorer sport utility vehicle factory in Chicago for a week last month due to a shortage of rare earth materials. And if we don't start getting ample supply of these, we're going to see factories all across the country grind to a halt. Workers are going to get on the unemployment line, and their lack of income is going to spread all through their local economies and then all across the country. But he has yet to see an improvement in the flow of magnets, and that's a key point. Those are used throughout vehicles to power components such as windshield wipers, seats, and audio systems. And without them, what are we facing? A complete shutdown of factories. Right now for Ford, it's just 1 week. But if we don't get a flow, that 1 week turns into 2. And then it's next thing you know, it's a month. And again, the longer people are out of work, at the same time, we're seeing the U.S. economy slow down. We're now facing pressures of rising energy prices, and that's going to be a huge hit on consumer budgets. What we're facing is, again, when we look at the catalyst of what pushed us right into a recession, China's blow to U.S. manufacturing could be it. We have applications into MOFCOM, and they're being approved one at a time, Farley said. President Donald Trump said fresh negotiations with China this week yielded an agreement for Beijing to swiftly approve export licenses for rare earths. Now, do you think that's actually going to happen? Because it seems unlikely that China has any real incentive here to speed up the exports, because they want a trade deal that's favorable to them. If they can start shutting down factories here in the U.S. and putting people on the unemployment line, well, that means the U.S. economy is going to spiral right into a recession, because we know there's two key things that cause a stagflationary recession. It's rising consumer prices, which could happen either due to the tariffs or to rising energy prices, and rising unemployment. If China's economy can hold out, well, it looks like they've got the advantage. Who do you think is going to come out ahead? Is it going to be the U.S. or China? Do they have an incentive to export those rare earths, or is that just a ploy just to make Trump happy? Weigh in the comments below. I'd love to get your opinion, because when we look at the state of industrial production here in the U.S. against the labor market, there's a very clear relationship. Let's take a look at industrial production in blue against continued unemployment claims in red, and you can see a near mirror relationship between the two. And you can see during periods where industrial production is rising, it means the economy is booming and people are getting work all across the country. And yet when production slows down, you see continued claims rise. That is the risk we're facing right now. You can see all the way back to around 2022, what happened. Industrial production came down. It flatlined right around the 0 mark. Continued claims bottom. They jumped. And you can see this blip in industrial production didn't transmit into hiring, because a lot of employers knew it had everything to do with front-running tariffs. Again, the issue here isn't for a lot of full-time employees because they're protected by contracts. The issue is for part-time employees and all the businesses that are surrounding these factories and these communities, and you can see the impact it's going to have on this next slide. Because there's also a strong relationship between industrial production and average weekly hours of production of non-supervisory employees. That note shown in red, so you can see anytime there's a deceleration or even worse, contraction in industrial production, the first thing that happens is you see hours getting cut. And that's why there's a very strong relationship between these two. And again, we can come back to this little blip in production, and what did we see? Hours worked go up. So we already know that the initial risk to this is we're going to see industrial production roll over and contract. If we see a lack of rare earths coming into this country, it means more factories like Ford's Explorer plant are going to go idle, and that's a major problem because, again, you see people protected by contracts, but there's a lot of people that aren't. The risk is if this goes on, you're going to see a lot of people hit the unemployment line, and that will be the breaking point for the U.S. economy. We're educating the administration. We're educating the Chinese leadership about how important these jobs in the Midwest are that are dependent on the supply of rare earth magnets. This from Farley. And yes, he's telling our opponent, he's telling China, look how critical it is. If we don't get these rare earths, it's going to put a lot of Americans on the unemployment line. And that's exactly what China wants to do. You look at who's trying to win this war. We tried to shut down their factories. So far, China's held on. If they can shut down our factories and put Americans on the unemployment line, well, you're going to see this trade war come to a real quick end. At least that's what my view is. How about yours? Weigh in the comments below, because imagine if you could have bought into oil producers ahead of that spike. Well, our Momentum Timer Pro subscribers did. We told them to buy XLE back on June 10th. That trade, as of close of business Friday, is up 4.31%. And here was the notes from the report that they got. Told them to buy on that open. We gave them the upside target, gave them risk control levels. Look, if you want to trade momentum and make trades like that, grab the links in the description below. Use the coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. Because import volumes to the busiest trade hub in the U.S. fell 19% from the month before, as we now turn to the Port of Los Angeles. So you can see what's happening with Ford is spreading all across the country. We said the Port of L.A. and Port of Long Beach were likely to be the catalyst. This is where it was going to start. Now we're seeing an impact in the Midwest with auto manufacturers, and you can better believe there's a lot of other companies that are reliant on those rare earths. And if China restricts them coming into this country, watch out, the pain is going to get real and fast. It's very slow here seasonally. This from the executive director at the Port of Los Angeles, and the consequences likely to show up on store shelves in a few months. So what he's suggesting, not only are they seeing a lack of demand there that we've already shown is putting people out of work. Now, they're not losing their job. They're not laying people off, or they're cutting their hours down to next to nothing, as hundreds of port workers can't get any hours. But the risk is going to next be to consumers. And what they're suggesting is we're going to start going to the stores here in the weeks to come, find out the shelves are empty, and then what shelves have products on, well, the price is likely to go up. So what we're facing now is U.S. consumers are about to see the brunt of the trade war, as those at the factory level and in trade and transportation are already finding out the hard truth. The worst part is it's only the beginning. Because not only is industrial production linked to the labor market, we look at imports of goods and services. Let's overlay average weekly hours of production and non-supervisory employees in red, and you can see the same relationship with industrial production. When we see a slowdown in imports, you get fewer hours. It's exactly what's happening in Los Angeles right now. As we see trade decline, well, that means people aren't working. When they're not working as much, they're not spending as much, and that flows all into the local communities and then all across the nation. Now, we did see a bump here in imports, but it did not lead to a significant increase in hours. Now what we're seeing is, again, the early stages of this trade war starting to take hit. That means imports coming down. They're going to be in contraction, and that's going to lead to fewer hours and less money for everyone. Import levies on goods from China remain prohibitively high for many businesses. When all is said and done, buying products out of China right now still costs 1.5 times more than it did earlier this year, making products of all types extremely expensive. And we're starting to hear from a lot of small business owners that are importing goods from China that they can still buy things. In some cases, the problem is they're already realizing that they cannot pass those costs on to their customers. Once they're done with their inventory, a lot of people that are reliant on trade with China likely to start shutting their doors, leaving a lot of people with no options and, again, no money. The danger signs for the U.S. economy are starting to build now, and you can see first it was the Port of LA, now we're seeing it hit Midwest manufacturers. And just watch in the weeks to come. If China doesn't increase those imports of rare earths, this is going to get ugly and fast. And then it's already starting to hit up in Canada. As we now look at Canada's trade-driven sectors, they're showing clear signs of a pullback in activity brought on by President Donald Trump's tariffs. Manufacturing sales fell 2.8% in April, the largest monthly drop since October of 2023 and the lowest level since early 2022, while wholesale sales dropped 2.3%. Both declines were deeper than the projections, and what that means for Canada is the same problem that U.S. workers are going to face is as production goes down, as demand declines, the demand for labor goes right alongside with this. So what you're seeing is everybody trying to win this trade war. What's going to happen is the likely outcome, the likely loser, I think, is going to be everybody when we face mass unemployment across the globe and a global recession at the same time. So far for April, we have a sharp declines in wholesale manufacturing, exports, and imports. Given the data at hand, the risk for Canada clearly skewed to the downside for April's gross domestic product with an early estimate of a mere 0.1%. So again, we're starting to see the early signs of the trade war hitting here in the U.S. We've seen them hit in China. We're seeing them hit in Canada. And we know this is going to affect industries and consumers all across the world. And yet, as we look to U.S. consumers right now, their optimism has jumped a little bit, and I want to show you why they've got this completely wrong and why it's likely to come crashing down right alongside with the economy. As U.S. consumer sentiment jumps on inflation expectations improving, and I don't think that's the entire story here. In fact, I think that's a little bit misleading because the notion that what we're seeing is a lack of confidence due to inflation. I'm going to show you the real link here and why the issues that we're facing at the Port of Los Angeles, Long Beach, and now at Ford are likely to have even far worse consequences than inflation. The preliminary June estimate index rose 8.3 points from a month earlier to 60.5. The figure topped all expectations as we saw confidence jump. Consumers now expect prices to rise at a 5.1% rate over the next year. That is down from 6.6% in May and marks the steepest monthly decline since October of 2001. So what we're hearing now from the experts is this has everything to do with inflation coming down, that consumers thought inflation was going to surge and that was really going to dent their spending. We said it had everything to do with their incomes, and well, here's the proof. Let's first take a look at the link between the equity markets and consumer sentiment as we overlay the University of Michigan's consumer sentiment survey in red against the NASDAQ 100 in blue. And what do you find is a wonderful relationship between the two. In fact, you can see confidence goes down. It's right in line with the equity market falling. In fact, you can see confidence tends to lead the stock market. And when the stock market starts to fall, well, confidence plunges. And we could see that throughout every cycle, except here recently you saw confidence dropping, but the stock market didn't. Now, keep in mind, a lot of consumers thought that was going to happen. They thought stock prices were going to come crashing down, but maybe there's another link. Maybe it doesn't have to do with net worth or investments. Perhaps it has to do with the labor market. Now let's overlay average weekly hours of production and non-supervisory employees in blue. And what do you see? Again, a very strong relationship. Consumer sentiment surveys are all about finances and jobs. And so here you can see the relationship as average weekly hours decline. Well, confidence, it starts to decline with it. And you can see that relationship going into every slowdown and every recession. So when we saw this recent decline, we thought, well, consumers know something that's not showing up in the labor market statistics. And that meant that we were going to see hours plunge. But you can see the link between the equity markets here from around 2022 up until 2025 that had to do everything with the stock market. So perhaps this reversal has something to do with both the fact that the stock market turned higher and from the fact that we see hours have not plunged. But it doesn't mean they're not plunging yet. In fact, we could see that here in the weeks to come, particularly what we see is going on with Ford. But how about that link to inflation? Well, we said previously it was way off base. Let's overlay regular formations gas price in blue now against inflation expectations from the University of Michigan in red. And we said before that this was not going to happen, that we noted that inflation expectations were nothing more than expectations and that this would come back down. Of course, gas prices didn't shoot up, and that is the main basis for how consumers gauge inflation. So it didn't happen, and that means expectations are going to get reversed. But the notion here that was all about price pressure, well, again, it's about the stock market and it's about the jobs market. However, consumers still perceive wide-ranging down risk to the economy, and absolutely they do. Because if you look what's going on in the ports of Los Angeles and Long Beach, you look what's happening at the factories in Ford, you look at the fact that we may not get the rare earths we need, and China has a stranglehold on this. If they choose not to go along with the deal they made and keep restricting supply, it's going to put Americans out of work. So yes, people have real risk here because they know demand is going down. They're going to work. They're not seeing the new orders. They're not seeing the backlogs. They know at some point their employers are going to at least cut hours and then be forced to cut jobs. A sustained improvement in sentiment may help ease concerns among economists and businesses about consumer spending and economic growth prospects. Unlikely, because it's all about incomes. Just because we saw expectations jump off a very low level doesn't mean consumers are going to come out and spend. What it's telling us is that consumers thought prices were going to jump so much that they wouldn't be able to afford anything. Now what they realize is they still can't afford much, but they can buy a little bit more than what they thought, and that isn't going to move the needle. The survey showed expectations jumped 10.5 points to the most since December of 2023. The current conditions gauge increased to a 3-month high of 63.7, suggesting again that everyone thought it was going to be far worse than it actually is, but it could get there. Keep in mind, and I'll leave you with this, is if we see, of course, what's happening in the ports of Los Angeles and Long Beach, along with what's happening with Ford, if we see this impact to the labor market start to accelerate and you start to watch continued claims move higher, watch that 2 million mark, because if that happens and hours work plunge, I'll tell you what's going to happen with those confidence surveys. They're going to reverse direction and come down crashing hard. But just because confidence crashes doesn't mean your brokerage account has to go down with it. Let's talk about that trade we put onto our subscribers for a Momentum Timer Pro report on XLE. Now, how did we know? Well, we knew because we saw it in the momentum indicators. We saw the energy sector starting to rise and build momentum and come off of an oversold position. We also noted the trend was up. And one thing about the markets, they often know what's going to happen before it really does, and this is one case we nailed it, and you could have too. Now, each and every day we look at those technical indicators like the RSI and the MACD, and we aggregate them together, and we look for when a security is coming off that oversold condition. But one thing we know is if you pair it with a rising trend, you get an amazing signal, and that shows up on our hot list each and every day. But in addition to that, you get a broad range of momentum signals on a 1 day, 1 month, 3-month, and 6-month window, so you can see how momentum is moving across the markets and trade accordingly. Now, you get the daily report. You get all those tradable signals. I review the trades and give you my opinions on the best ones. We give you risk control levels and update them along the way. We give you a full tracking of all open trades and returns, a weekly update, and here's the best part of all. You get that 30-day free trial. And why do we do that? Because we want you to jump in on amazing trades like XLE. How do you do that without putting out a dime? All you have to do is grab those links in the description below. Use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.